And welcome back to Brain Wealth, where we talk about ways to protect, grow, and enjoy your wealth that you have worked so hard to build. Today's episode is for those of you who feel like the market's been a little unpredictable lately. Maybe you've been sitting in cash, maybe just tired of that roller coaster feeling when you check your accounts. So let me ask you something. What if there was a way to grow your savings without putting it at risk in the markets? This is not a too good to be true pitch, but a real strategy that more and more investors are turning to when they want peace of mind without missing out completely. And that is what we're diving into today on Brain Wealth, fixed index annuities. And here to tell us about it, and before you tune us out saying, whoa, that's too complicated, here's a man to make it simple and explain it. Your host, Bryan Repple. Bryan, good to see you.
Hey, Bill. Yeah, we've been talking a lot. I've been doing a lot of shows recently about volatility, risk, the overall market. And I think this show really, I just want to be kind of getting a little bit more intentional of, what is a specific financial instrument, a strategy that can bring some more peace for those individuals that are looking for something that are saying, hey, I don't like the choppiness. What's a strategy here?
Yeah.
So that's what we're going to get into today's show.
So tell me about fixed index annuities. I mean, a lot of people have a reflexive action, action when they hear that word annuity, and so lay that out for us. In a world of market volatility, political uncertainty, and people living longer, what makes a fixed index annuity unique for someone who wants to protect their nest egg?
Yeah, great question. So the idea is, let's just start with the basics. Let's back out versus getting into listening to the ads on TV, say, do this, they're against this or for it. There's a lot of noise out there. So let's just get down to the basics. So many people may have heard of the word annuity and immediately they tune it out. You're not alone. And it's okay. But the version we're talking about today is what's called a fixed index annuity. So just use the acronym FIA. This is a very different financial instrument. So simply breaking down a fixed index annuity, it's a financial tool. It's an instrument that protects your money. Just think about that. The word protects your money. And it protects it from market loss, and it still gives you the opportunity to grow. And the way it gives you the opportunity to grow is based upon how well a market index is doing. So let's just take the S&P 500. That is considered a market index. So it gives you the opportunity with a market index. The S&P 500 just went down. Let's just say it went down 20%.
Okay.
Just as an example. Well, if it goes down 20%, the fixed index annuity, the tool, would say, hey, your money was protected. Kind of cool. So you're like, okay. So it gives you the opportunity to sleep at night. And on the upside, let's assume the index started to grow. And you're like, hey, I want to participate on the market index when it grows. So you have that availability. So you're not actually buying stocks or ETFs. All you're doing is tracking an index through an insurance contract. So I like to think of it like this. I like stories. I like maybe little metaphors.
Yeah.
So think of it like riding an elevator in a luxury high-rise building. And I use that luxury high-rise because it's your money. Your money is the luxury of your money. So you can go up when the market or the index performs. You want to go up. You want to take the elevator up. But let's assume there's a safety lock on the basement of your money, on that building. You can never drop below the ground floor. Okay. That's the essence of what a fixed index annuity does. You get to participate in some of the growth of the market, because they have ceilings of how much they will allow you to participate. But the beautiful part is you avoid the fall. And the third part to this, so you participate in some of the growth, you avoid the fall. And the way I personally like these fixed index annuity instruments is the ones with no expenses to them. So
What?
there are different variations. Again, I will just preface this. This is not financial advice. We are talking through strategies, concepts, speak to a professional about these. And there's all sorts of variations of the word annuity. So annuity is just one term, and there's variations of this. So we're being very specific today of talking about what's called a fixed index annuity, not variable, not immediate, not those other terms. We're just talking about a fixed index annuity with no living benefits, no fees or expenses on them. I'm just getting down to the core. Participate in some of the market, avoid the fall, protect your assets, and do this with no expenses.
Well, okay. Can you or will you please walk us through a real example where someone used a fixed index annuity not for income, but purely as a safe place to ride out market risk?
Yeah, no, it's very common.
Please?
We have, yeah, like a lot of people that think of annuities because they think of the word, it's like, oh, if I invest in an annuity, I'm doing it to get a pension. I'm turning my money over to the insurance company.
Right.
That's not what we're talking about here. So I'm making sure I'm being very clear on language, because language is so important. When we hear this stuff on the news and they talk about Susie Orman or Dave Ramsey saying an annuity is bad. Well, not necessarily. Not all things are what they are being told they are. So many of our clients, when they are retired or they're approaching retirement, we will add a portion of their portfolio into a specific fixed index annuity. So the reason I'll just kind of give you a story. So like many clients, they've gone through the market roller coaster, 2028, 2029, 2022, what we're currently experiencing of April 2025. And you'll hear them say, I'm done watching my account drop. Every time the headlines go nuts, every time things get crazy, I see my account volatility. I just want to grow without that gut punch, without losing sleep at night. That's a very common statement framed differently for clients. Everyone has a different way of saying it, but at the core, what they're really saying is, I want to protect a portion of my money or all of it. And I still want to be able to have some growth, but I just don't want to lose sleep. I'm tired of that experience. Yeah. Well, that's where this strategy of a fixed index annuity provides stability, peace of mind, and plays out for those type of clients. So this is not for the gambler. If you're the person that says, hey, I enjoy the roller coaster ride, the 30, 40, 50-year-old, this is probably not this strategy. This is for the person saying, hey, I'm nearing retirement and I can't afford another 2008. This is a perfect strategy for that. We may not put all of the account allocation, but we ask the question, what's the appropriate amount? If you're holding too much money in cash and you might not be earning on your money, this is an appropriate strategy. If you're sitting in bonds or CDs that no longer are rewarding for being in there because there may be volatility in the bonds, or the CDs are starting to go down in interest rates, this may be a strategy. Or if you're looking to, I'm going to call it de-risk, take risk off the table from your portfolio without walking away without the growth. So these are the individuals that may, I'm open up their listening saying, oh, I relate to that. I could be sitting in too much cash. I'm seeing volatility in this and I want to take some of the risk away. This is the type of individual we are able to set it up without the fees or expenses that other annuities or other financial instruments do incur, and provide that safety, that peace of mind. And still, when the markets participate on the growth, because what's nice right now is with these instruments is adding money to a fixed index annuity when the markets are where they are. Eventually we will roll out of this market. I don't know when, I'm not projecting the future, but if or when they do, and we have growth, the index annuity will be positioned to ride that growth wave up. Now, I'll give you another story here, Bill. I get clients that come in because they own these instruments. Now, when the markets, they will come in during this period of time, I would expect in the next 6 months, I will get a client that says this, Bryan, I own this this company, this instrument, this annuity, and I made no money over the last year. They'll be a little upset. You'll feel their, and I say, well, let's understand this. So basically your account had, let's just say $100,000. You had $100,000 last year and you still have $100,000 today and it didn't earn any interest and you're upset. So I always ask the question, if you didn't earn any money, what had to happen in the overall market or economy? What had to take place for you not to earn any interest? That means everybody else in the markets or the economy had to be down. Your neighbors had to be losing money. See, this instrument was designed to protect the downside of the markets. So, client, and I laugh, they're like, oh, that's right. And I've had conversations with clients lately saying, hey, you're good here. Being in April, we didn't go down with the markets with this particular instrument. So this is why we like having guardrails in place for our clients, pre-retirement or especially in retirement, that when the markets get volatile, we have these type of assets to help buffer the downside. So when the market part of the portfolio is getting volatile, we offset it with these type of instruments. And this is great for the income planning portfolios too.
So this is a way. So it's a way of balancing the portfolio. Really, that it's the first time I've heard somebody talk about it in this kind of way.
Yeah, absolutely. The whole idea, it is about, I use the idea of if you go up to look at a pilot and you're looking at all the different instruments they have in their cockpit, financial plan is the same one we're doing with our clients. So when a pandemic hits, election uncertainty, I can go back to the 90s with tech heavy market. And we had the 2000, 2001, 2002. And right now we're just dealing with geopolitical inflation, tariffs, and all this talk. What people really want is emotional security, knowing they're not going to open a statement and see massive loss. Yeah. That makes it feel good. So if we have some loss on their portfolio side, to be able to buffer it and have other financial instruments that are non-market correlated that did not go down at all, it really brings a sense of peace to the overall portfolio. And that's what a lot of people get. They get so focused on one statement and they see the one thing. But when you're able to bring context and say, wait, the one side may be down, but from an entire portfolio side, we got to give a macro to individuals and say, it's okay. And here's how we're going to pivot during this uncertainty. So it gives us a permission to stop micromanaging every part of the markets of saying, hey, yes, we're getting a little volatile in this piece, but your portfolio as a whole, by having these safer strategies in place, it gives us permission to adjust how we're taking income or managing risk in these uncertain times. So yeah, if for individuals that don't have them, we want to make sure we have fixed income instruments, income producing assets that help buffer or provide guardrails. I always use that term guardrails, especially for my retirees, for the individuals that are creating income in their life out of their portfolios. We want guardrails, and that's why we have them is in these uncertain, and are these times uncertain? Okay, maybe 2008 was uncertain. Every day is uncertain.
Well, I would argue that the answer to that question is yes. Things are uncertain, and markets hate uncertain. They hate that sense of uncertainty, which is why at this particular point in time we've got markets that are reacting in this kind of wild, crazy, volatile way. That would be my answer back.
Yeah, absolutely, absolutely. So there's a fear of uncertainty, but when we go out a year, 2 years from now, the noise of today will be so quiet and so forgotten because we've already forgotten about 2008. And it's really interesting. Clients, our own behavior, all people's emotional behavior intelligence, even after 2008, clients that were so risk averse after that were wanting to take market risk coming out of it. You're like, wait a minute, let's go back. If that ever experiences again, we want to make sure we're not going to lose sleep. So I always have to that's why it's every individual so special and personal about how we manage them as an individual, their risk, their plan, their strategy. That's why everything we do is rooted in their values and their goals, where they're going. So, I just think this conversation is so important. The last couple of conversations we've had on this podcast, it's really so much about emotional behavior and navigating, yes, uncertain times, uncertainty of what's going on globally, but we really get down into how have we prepared individually for it? And when I spoke to some clients the last couple of weeks, they're like, well, thank you. I was listening to the news and I was so concerned. But when I hear you talk about our situation individually, I'm like, it's cool. Go on your trip. You're fine. It's going to be great.
Outstanding. And for people who are not your clients who might want to have a conversation with you, Bryan, what is the best way for them to reach out and talk to you?
Yeah, absolutely. So if you're looking for clarity, purpose, and ways you can navigate not just these uncertain times, but even when we do come out of it and there's opportunity, we want to be there to bring that clarity and put a plan and strategy in place for you. In uncertain times, your portfolio doesn't need to be aggressive. It needs to be smart. And sometimes the smartest thing to do is just reach out to ReppleWealthGroup.com. Let's sit down, have a 20-minute conversation, see what's going on in your life, put a plan together. You can reach out to me at Bryan, BRYAN, at GARepple.com, and we will help silence the chaos and really look at what's right for you, put that plan together. Again, this is not investment advice. This is planning, strategies, and concepts we're looking at teaching, and look forward to speaking with you.
Absolutely. And for those of you who are listening to this podcast who might not be a subscriber, do yourself a favor right now and hit the follow button. Become a subscriber. That way, every time a new episode of this podcast is released, you are notified. You don't have to wonder where you heard it or how often they come out. You'll be notified and you can give it a listen. I would also ask that if you like the podcast, give it a great rating and share it with people. Tell people about it. Until next time, I'm Bill Tucker. On behalf of Bryan and everybody at Repple Wealth, thank you for taking the time to listen today. And do remember this, you do have a choice. You can go out today and make today a great day or not. The choice is yours. Until next time.
Thank you for listening to Brain Wealth with Bryan Repple. Click the follow button to be notified when new episodes become available. Visit our website at www.repplewealthgroup.com. That's REPPLE wealthgroup.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Bryan Repple. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Bryan Repple is a registered representative and investment advisor for G.A. Repple & Company, member of FINRA SIPC.